This course is, the current governor, Urjit Patel, wrote a report when the previous governor was the governor, and it's the Urjit Patel inflation targeting report, which you should read. And so let's go through first what are the objectives of monetary policy transmission and framework. Okay, so when we speak about the objectives of monetary policy, basically two broad objectives. You want to keep inflation and inflation expectations low. So it's not just that you keep inflation expectations low, because when agents plan for the future, they plan based on inflation expectations. So you want to keep both low and stable. So it's both inflation and inflation expectations. You want it to be low and stable. The opposite is if you have high and variable inflation, you have costs. And like fiscal policy, it helps stabilize the economy. I'm going to show you what are the features of this, but also importantly, avoiding and responding to financial crises. So now, why is price stability important? Basically, high and variable inflation creates uncertainty. So the point simply is that if I'm an investor, if I don't know what inflation is going to be, and if I don't know how uncertain inflation is going to be, that's going to affect my investment, and that will reduce the economy's supply potential, how much it can produce. So essentially the job of keeping monetary policy inflation stable is to ensure that planning in an economy is possible for private agents, and the better you can plan, the more will be the supply capacity of the economy, because there'll be more investment. Similarly, also consumers can actually consume what they're going to buy in the future. They can plan that better if there's inflation. Now, there's another reason why you want to keep inflation low. That is, inflation actually has impacts on the distribution of income. And there's a very famous saying, I think, Pope Paul II, I think once he was in Latin America, he would go there, because Latin America is a continent that used to have 5,000% inflation, and he would go there and say, look, I represent the poor, and the biggest tax on the poor is inflation. So we must avoid inflation because it's a tax on the poor. Remember that inflation redistributes resources. If you save, the value of your savings come down. If you've borrowed, the value of the debt comes down, and you're better off. So if you have 100 rupees of debt and inflation goes up by 5%, the amount you have to repay in real terms comes down by 5%. Now, why is inflation a tax on the poor? It's a tax on the poor for the simple reason that, if you have assets, you can hedge yourself against inflation. Say, you get some money, but you own real estate. So you may get hit by inflation because the real value of your income comes down, but then your prices, your land prices, your property prices may go up, and that acts as a defense, as a cushion against it. The poor generally don't have assets, and so they're much more vulnerable to inflation. So I think that that's very important to keep inflation down. In fact, I have heard several Indian politicians, personally, I don't want to name them, who have said that there is a kind of iron law of Indian political economy that they had internalized, that any time inflation got high, it was actually disadvantageous, and people could lose elections based on high inflation. My Tamil friends are here, so I have to tell you a story. And please correct me, my Tamil might be very bad, so please correct me, and also correct me whether I'm saying this right and whether my facts are right. My earliest political memory growing up in what was then Madras was actually, I think 5 or 6, and I was standing and a procession was going by, and I'm going to say this in Tamil, is that it was a Congress government in power then, and the slogan that went by was, Venkatraman enache, Vengayam vela enache, Kamaraj enache, Kadigu vela enache. Nyabarka, sir? Do you remember this? Do you remember this? Correct? So essentially what people were saying was, look, with Kamaraj and Venkatraman was then finance minister, I think, of who later on became president of India as well. Under them, prices of onions, Vengayam is onions. In all languages, people want to alliterate, Venkatraman, Vengayam, Kamaraj, Kadagu, KK. So, it's a common feature of all politics. And so it was a big political issue. And I don't know whether in that particular election, it turns out they did lose the election. And I think inflation was an issue. Whether it was due to this, we don't know. But, this is it's an early political memory. And, several politicians.
Something happened in Delhi, sir. BJP could not come in power because of the onion prices.
Delhi lost election in 19.
I was trying to go back in history. You brought us back to. That's true. Very, very true.
Changes in Indian politics things.
Yeah. So it's also as a political matter, I think. And so here's a chart of how Indian CPI inflation has been over many periods. And I think what I'll show this to you later on. I mean, by the standards of emerging market countries, Indian inflation has not been too high. I think the average has been about 6 or 7, not quite the 5% that politicians claim, but generally it's been not very high. Now, here's what I want to explain. Remember I said there are two objectives of monetary policy. So one way to think about this is, so you think of this line as, think of this graph as, quantity and prices, and think of the yellow line as representing the potential of the economy. That's the supply, that is the maximum it can produce in the economy. And therefore think of low and stable inflation as basically making sure that the economy remains like this, doesn't become like this, i.e. reducing the potential of the economy. That's the role of one of the objectives of monetary policy. The other objective is, given potential, you can have, if you have amplification like this, it's a kind of, you have highs and low, it creates a lot of instability. What you want is to dampen these and have this, the dotted line where you kind of, so if the economy is overheating, you want to tighten and bring it back to potential. If the economy is underperforming, you want to boost. So that is what is called the stabilizing role of monetary policy. One is you want to maintain the maximum potential. The other is you want to minimize the fluctuations and maintain macroeconomic stability. Now, this is just a chart of the US. In the 90s, there was the Great Depression. And in fact, they were not able to prevent the Great Depression. And there's a lot of monetary history that shows. In fact, there's a whole book written by Milton Friedman, who won the Nobel Prize, and Anna Schwartz, about how monetary policy let down the Indian economy by not being responsive enough. Then, of course, in the 70s and 80s, we had both high inflation and weak economies, what we call stagflation. There were two oil shocks, and this economy underperformed. Again, stagflation. It wasn't, the world suffered as a result of that. And of course, most recently, we've had, after 2008, a global financial crisis. And there, I think many would say that monetary policy did learn from the lessons of the Great Depression, and and central bankers just went out of their way, did all kinds of crazy things. I mean, I put crazy as in things that they've never done before, in order to stabilize the economy, in order to prevent something like the Great Depression happening once again. That's why when you hear terms like quantitative easing, so because remember that after the global financial crisis, for the last many years, interest rates have been zero or close to zero. In some cases, they've also been negative. Nobody thought that interest rates could become negative. But negative interest rates basically means that you are paid to hold money. And then, so all kinds of crazy things happened. But people think that it was a response to learning from what happened in the Great Depression. Of course, there are critics saying that it's gone too much, it's creating another kind of instability. So the bottom line is that you want to keep stability in the real economy, i.e. deflation, inflation, but you also want to create stability in the financial economy. You want to avoid financial crises and financial instability as well. Okay, so here's something very, very, I think, simple but important to understand about how does monetary policy work. So, you hear, all these debates, growth is too low, therefore, central bank should cut interest rates, inflation has become too high, central bank should raise interest rates. But the question is, how does it work? What is the transmission mechanism from what the central bank controls? What is the policy lever that it controls? How does it affect the economy, and via what channel? So essentially, if you think of it this way, today, in the past it was different. Today, the main lever that the central bank controls, it's what's called the repo rate. It's an interest rate. It's an interest rate which, strictly speaking, is the interest rate that the central bank charges the banks to borrow or to sell this. So that's the short-term interest rate. And that interest rate then determines all other interest rates in the economy. So for example, supposing the central bank wants to boost the economy because inflation is under control, but the economy is underperforming, i.e. growth is much slower than what the economy is potentially capable of producing. What they do is they would cut the policy rate. Now, how does that work? So essentially the way that works, you see this chart, the red line is the policy rate, and the blue line is the lending rate. So what happens is that central bank cuts its rate. In turn, the banks cut the rate that they charge their borrowers. So what does that do? That can stimulate two things. It can stimulate investment because interest rates have become lower, projects that were hitherto unprofitable become profitable, and also firms will spend more, they will borrow more and spend more. So that's one channel. The other channel also is that real estate, for example, loans become cheaper, and people also buy consumer durables as a result of that. And so when interest rates come down, so essentially what happens is that when interest rates change, spending decisions by firms and households change. So if the economy is weak, you want both of them to spend more. If the economy is strong, you want them to spend less. So that is the first channel for transmission from interest rates to the real economy. What is the second channel? The second channel is exchange rates. So we're going to do this in a little bit detail later on, the international trilemma, but essentially that if you have capital flowing around the world, say interest rates in India are 5%, interest rates in the US, let's say, are 3%, and let's suppose that people expect the Indian exchange rate to depreciate by 2%. That's when you're in balance. You get a lower return in dollars, a higher return in rupees, but at the end of the year, because the rupee is going to be weaker, that's what maintains. That's called the interest parity condition. If you have higher interest rates in India, that will be offset by the fact that the rupee will depreciate, and that's what maintains equilibrium between whether you want to invest in dollars or rupees. Now, supposing you lower the Indian rupee interest rate, then relative to before, what will happen is suddenly investing in India will become less profitable. So foreigners and other Indians who can take money out will take money out of India, invest it elsewhere in the world, and that will mean that when this capital flows out or less capital comes in, the exchange rate will weaken. So the exchange rate will weaken, and when the exchange rate weakens, what happens? Indian exports will be stimulated. Indian, also you will buy less imports and buy domestic products instead, and that will also stimulate the economy. So when interest rates come down, exchange rates come down. When exchange rate comes down, for example, a lot of textile exporters, for example, have been complaining that the exchange rate has become too strong now. So Tirupur, for example, to go back to my Tamilian friends, Tirupur, for example, which has all these clothing and textile exports, or even the Delhi, when the exchange rate goes down, they actually export more because it becomes more profitable to export, and that's another way the real economy is affected. So interest rates come down, exports are stimulated, the economy is stimulated.
Provided global conditions are.
Yeah, all this is ceteris paribus. All this, you don't want to change everything else. Everything is ceteris paribus that I'm saying. So one channel is interest rates affects borrowing and therefore spending by firms and consumers. The other is the exchange rate channel. There is a third channel, which actually in India is very important. So when I spoke about borrowing, the way it works is that banks lower their rates, people borrow more from the banks and spend and invest. But when interest rates also affect savings decisions by us. So if, for example, interest rates go up, it pays for us, all of us, to put more money in deposit accounts, right? So what we do is that when interest rates go up, we put money in deposits rather than spend it somewhere else. So interest rates have also affect financial savings. So if therefore you persuade households to save more, that means they're spending less, and that will also affect the real economy. So in this example, when interest rates go up, instead of spending on goods and services, people will save more, and saving means that there's less consumption in the economy, and hence that's another channel through which it works. So the borrowing channel, the exchange rate channel, the savings channel, all are important. Now, just one small aside is that this is in the current Indian context. What we find is that there's been a lot of discussion about the central bank, the RBI, cutting rates, but the banks not cutting rates by as much. So you see, for example, the RBI repo rate has probably come down 175 basis points. You see, 1% is 100 basis points. So that's the language we use. It's come down by 175 basis points, the red line, but the blue line has come down by much less. So there was a lot of discussion over the last 2-3 years. Transmission mechanism is not working. So when you hear the word transmission mechanism, that means the policy rate comes down, but the banks don't pass that on, the benefits to borrowers. Now, part of the reason it's happening today, is because, remember, banks have a lot of bad assets, non-performing assets. So one of the ways they try and build up their profitability is they borrow less. Their borrowing costs come down, but they don't pass it on. They increase their margins as a way of making greater profits in order to strengthen their balance sheet. So think of it this way, that if the central bank can increase its profit margin, so the policy rate comes down, they get funds cheaper, so their margins go up. They don't pass it on to consumers. So the margins widen for the banks. They make profits, more profits on all the loans that they make, and that improves their profitability. So because of this current situation of NPAs, you find that the transmission mechanism has become weaker. So I think these are all things I think are really worth explaining to students when you discuss monetary policy. Yeah.
How much do we know about the spread between formal credit and informal credit? The transmission level was between people who would borrow formally and lend informally, does it impact? How much does it impact?
This is interest rate stickiness, sir. If I have read a paper by. So is this is in case of lower the interest rates when it is lower. Is this the trend similar in when the interest rates are increased?
So those are so the two questions that were asked are that how do interest rates work when there's also an informal market? That's one question. And the other question is there symmetry in terms of transition mechanism between reductions in interest rates and increases in interest rates? Now, I know I have seen some work. See, remember that the question that you're asking is relevant even when there are no NPAs, right? Even when there are no NPAs. And I have seen some evidence where banks are more aggressive about raising rates when this comes down and less when that. So that's certainly there is some evidence on that, but this aggravates that problem in some sense. On the formal, informal, I don't know exactly of studies, but clearly there must be some substitution going on because these are all alternatives. After all, when I say when interest rates go up on the savings side, it may not necessarily be that aggregate savings go up. It may just be that financial savings go up because you want to transfer from informal to formal methods, and that's an example of. In fact, this is something that work that I did, and it really does show that deposit growth and real interest rates are highly correlated, so that the financial savings channel does seem to work. You see, the correlation is pretty strong. When real deposit rates go up, deposit growth goes up, and vice versa.
So transmission mechanism may be weaker if you take lending rate. Lending rate is a better proxy when you talk about interest rate mechanism. Because here we have seen transmission mechanism somewhere here, but toward the end of the some period, transmission mechanism weak because of NPA. But lending rate could be a better proxy than deposit rate because of the credit.
See, but that's what I'm trying to say, that both channels are possible. Both can work. You can work both on the credit side, but also on the savings side. Both affect the transmission of monetary policy. If lending rates come down, you borrow more and spend more. But if lending rates come down, it's possible that people switch back into informal savings over formal savings. Both are possible, yeah.
In the previous graph, it's a bit lame question, but previous one. Why, the deposit rates has to be higher than repo rate when the banks can get money cheaper from RBI? Why they want to take deposits from people?
Yeah, because there are limits. You can't borrow a lot from.
So, at this moment when you have a lot of not making much loans.
Yeah.
It makes sense to cut deposit rates further so that you don't get too much deposits on which you need to pay interest to.
Yeah, I think that in a normal situation, you want deposits because you think you can lend it out and make profits on the margin. But when the lending atmosphere is weak, or because you have a lot of NPAs, you can't, then it's. Well, but then, you may still want to borrow and invest it in government deposits, in government securities, and then you can make the difference on that as well. Yeah. Okay, so let's move on. And so it's very important to understand how, interest rates work in terms of stabilizing the economy. Inflation is very high. You want to jack it up, the interest rate. You want to make the cost of money more expensive. And that's how it gets transmitted to the rest of the economy. Yeah.
One question, sir. Recently, we have shifted to marginal cost of funding kind of thing. So, has that worked over here? Because we can't see much reduction in the base rate.
It's a
MPA that is causing the stickiness in base rate, or there are some other reasons.
So when Raghu came to was in the RBI, he instituted this, because he felt that banks were not charging it. So he said that banks should lend, their transmission should be based on the marginal cost of lending, not on the average cost of lending, and that's what he made this. So now I think it has forced banks to actually be much more responsive to interest rate changes. The exact magnitudes I don't know, but in fact banks complain now that when a policy rate goes up or down and deposit rate goes down, they are almost automatically forced to reduce that. But it's not one-to-one. So, but it is something that has changed because of what Raghu changed the policy. Raghuram Rajan changed the policy on this. Okay, now we want to move to India's monetary policy framework. India has recently shifted to an inflation targeting framework. And so just to give you a sense of the chronology, I think that about 2 or 3 years ago, 1 year after the Urjit Patel report came out, the central bank was de facto following an inflation targeting framework, which I'm going to explain what it is. And last year after the budget, we formally, there was legislation that was passed by Parliament to make this inflation targeting framework a law. So now this inflation targeting framework is the law. How the central bank is going to conduct its policies are laid out in this, and now the government now cannot interfere with what they're doing. So this has now become almost a standard framework in most central banks, notable exception being the United States. I think almost every advanced country, the European Central Bank, New Zealand, Australia, Canada, the UK, all follow inflation targeting frameworks for running monetary policy. Now, why did this inflation targeting become popular? Just to give you a sense of a history. See, before this, it's not as if central banks were not interested in controlling inflation, but it was not very clear what the framework was, and also what the objectives were. There was no, central banks could do a little bit of that, a little bit of this, and also control inflation. So there was a lot of uncertainty surrounding that. And some central banks, what they used to do, especially in Latin America, they would target the exchange rate. They would keep the exchange rate fixed in order to bring inflation down. See, remember that if in an economy you import a lot of what you buy, then basically if you keep the exchange rate stable, your inflation will also be stable. So many countries used to say, I'm going to keep the exchange rate fixed in order to keep inflation down. So, but essentially what happened was, where is the chart? Okay. Essentially what happened, why did countries move to inflation targeting, is that this was the experience of the world in the 70s and 80s. You had pretty decent inflation before, but then after the 2 oil shocks, inflation shot up across the world, everywhere in the world. And then basically central banks said, we have to now start focusing on inflation much more seriously. And that's how it got into, they got into an inflation targeting framework. Can someone guess which was the first country that adopted the inflation target? New Zealand. All of you know this is amazing. How did you, do you know what the origin is? There's a very interesting story on this. It almost happened by accident almost. So there was the central bank governor was a Kiwi farmer, I think inflation then was running at about 10 or 11%. And one December, the story goes that he was chatting with a friend of his, and the friend of his said, I had invested a lot of money in government securities, and over a 5 or 10 year period, it got entirely wiped out because of inflation. Because remember, if you hold a government bond and inflation starts going up, your returns get eaten away by inflation. So he said, oh my God, this happened to a friend of mine. What should we do? And then they quickly had these discussions, and they rammed this thing through Parliament, and it was approaching December, Christmas. The main guy who was opposing it was in hospital, so they took advantage of that to push the law through, and that's how it came about. It's one of those very interesting stories. And like the 3% deficit target and the 60% debt target that somehow came about somewhere and all countries have followed. This inflation targeting, and especially the level that they chose for inflation of 2%, was a little bit quite accidental actually. So the story goes that they said, okay, we target inflation, but what should the target be? So they said, oh, 0, it's too tight, maybe a little bit more, 0 to 2. So there was a question here about, in the morning, what kind of models do you have to decide, this, that, and the other? And this is an example of how kind of a little bit of give and take, a little bit of, very, very loose economics leads to this thing. So that's how it came about. And then once New Zealand adopted it, Canada, Australia, all these countries, one after the other, adopted it, and it became very, very popular.
Can I ask a question?
Please, please.
This UAE is having a peg, the currency,
The peg, yeah.
United Arab
Yeah.
And still, by doing pegging of the currency, they are targeting the inflation. So that last point, don't you think that this UAE is an exception to?
So remember, I didn't say that all countries are adopting inflation targeting.
No,
So I tell you, good question. There are two sets of countries that still maintain an exchange rate peg. Almost all the oil countries, because remember, for oil countries, it's the price of oil that basically determines everything, and oil is priced in dollars, so you want your currency to be stable against that. And there are some countries like Hong Kong that still peg their currency to the dollar. So there are some usually oil-related companies or countries, oil-producing, and small countries which for historical reasons still maintain the peg to the dollar. Now, the thing about this, of course, is that when oil prices start collapsing, as they have for the last thing, they do come under strain, and there are now lots of discussions about whether a peg is good for these countries or not. So it's one of those perennial questions that we talk about. Now, the question is, I've spoken about inflation targeting. I've said inflation targeting, but what does it mean? What are the objectives? What are the supporting frameworks? And what are the decision rules? So what do we mean by inflation target? I've showed you this. We've been through why we have an inflation target. We said, maintaining price stability is very important. The question is, why did India choose an inflation target? Nearly 2 decades after, remember, New Zealand adopted inflation targeting in 1989, and since then, as I said, there was a trend all over the world, and India came late to the party. It only de facto adopted inflation targeting about 2.5 years ago or 3 years ago, and de jure formally adopted it only last year. So after about 2 decades, we did this. Part of the answer I gave you earlier, why we did not have inflation targeting, very simple. We did not have inflation targeting because democratic politics had, favored relatively low inflation. So you didn't need any fancy, inflation targeting, this, that, fancy rules, because democratic politics, it was an iron law. So even when, central banks were not independent, the objective function of the central bank and the government, i.e. that of the politician, was not very far apart. And that's why historically we had relatively low inflation. I'm going to give you a chart. This is the difference between inflation in India and inflation in the rest of the world, or at least in comparable countries. Negative means we had inflation below comparable countries. Above means we had. So you see, for most of our history from 1980 and before, we had relatively low rates of inflation. And that's the reason why we never felt we really needed to have inflation targeting, because generally people wanted low inflation and stable inflation, and that's what we got.
Nature has also been different, nature of inflation, right?
In what sense? So the question is, the nature of inflation is different. In what sense?
Basically, it had been a kind of skewflation.
Sorry, kind of?
Skewflation.
Meaning, can you explain that, please?
A bias to sort of sector specific, right? Due to rigidities due to supply side.
Correct. Okay, so you're saying that basically in an economy like ours with structural rigidities, some sectors would have, like agriculture, for example, would have higher inflation. So that's possible. But I think that basically we were doing quite well, and India was considered a haven of inflation stability, but something changed dramatically. You see, since about 2007, 2008, inflation started shooting up. Remember, the origins of this were food prices went up, oil prices went up, and inflation went up. And inflation remained well above the world and remained in double digits. So for this period, almost, let's say, this is 10 is double digit inflation. So almost for this period, let's say 2008 to 2000, almost 5 years, we had double digit inflation. So in that sense, we broke from our past of a stable past, had high inflation. That's when talk started quite seriously that, we should not allow this episode to repeat itself. And that's why we should have inflation targeting. So that's how the history changed in India. That Huh?
Is it CPI?
Oh yeah, that's CPI. That one is CPI. We used to follow. We have many CPI indicators. I'll come to that in a second. But broadly, that's a CPI. We don't have consistent series of CPI going back in time. That's a that's for example, a great thing to give your students would be to see how the different series have done. To especially when there are common data points, to see how the two series behave is something that you should be. So until recently, there was no pressing reason. Then after the global financial crisis, we got this, and that's why we started adopting inflation. So IT inflation targeting is a little bit like the Bhishma vow that I told you about yesterday, with the difference that it's basically the central government saying that we will set an inflation objective and we will empower the central bank, the RBI in this case, to meet that objective, and we will not interfere with how they achieve that. So it's a commitment by the government and RBI that they will never allow this to happen again, to show their seriousness, and it's now in a law, and it's an inflation target. So there are 2-3 aspects of an inflation targeting regime. The first thing, and I think probably one of the very important aspects, is the law says that inflation control, or keeping inflation down, will either be the only objective of monetary policy or will be the primary objective of monetary policy. So remember that I said that monetary policy has 2 objectives. One is to keep inflation low and stable, and the other is to stabilize around that. An inflation targeting regime says we will mostly focus on inflation control, because the logic is we think that having low inflation is the best way for the economy to perform at its potential, and insofar as there are other objectives, they will be secondary to controlling inflation. Okay, so I've been through this before. So previously, the United States, for example, has an explicit dual mandate, both inflation and unemployment. They have to keep unemployment as low as possible, as close to normal as possible. So before inflation targeting, you have a loose multiple objective. You bothered about the exchange rate to some extent, you're bothered about inflation, you're bothered about the economy, you're bothered about savings, and you do a bit of everything. Whereas in an inflation targeting regime, you have to do one thing primarily or even exclusively, which is to get inflation under control. And the thing is that there is a famous intuition that goes back to Jan Tinbergen, who won the Nobel Prize many years ago. He said that in general, in economic policy making, if you have 2 objectives, you must have 2 instruments. If you have only one instrument, unless you're very lucky, you will not be able to meet multiple objectives. And so the question is, that's the logic of why do you have only one objective? Well, basically they only have one instrument, therefore you can't have multiple objectives if you have only one instrument. So that is kind of the logic of having, okay. But then it is not that they don't care about other objectives. At least 3 other objectives they care about: growth, exchange rate, and financial stability. So the question is, how do central banks deal with these objectives under inflation target? I've just said, if interest rates are too high, they could kill the economy. So how can you do, chase 2 targets? One, you pray to God.
Fiscal policy has to coordinate.
Yeah. So one answer here, of course, is that a good answer is the 2 have to coordinate. That if monetary policy looks after inflation, fiscal policy has to look after something else. But remember, fiscal policy, it's also constrained because fiscal policy is trying to meet multiple objectives. You have to have credibility and you have to use it to stabilize. And moreover, until very recently, the whole objective of this exercise was not to coordinate too much, because previously, previously when they coordinated, as you said earlier, they monetized the deficit, and so central banks were basically puppets of the government. So they said, no, that's why we must have independence, because we don't want you to monitor.
In that case, there was no coordination, rather there was a sort of
dominance. It's called fiscal dominance. Yes, fiscal dominance. So now, in fact, that's a good point we'll come to at the end about how now the thinking even on that coordination is changing. In the beginning, coordination meant dominance, so they said let's become independent. Now when it's become independent, we're exactly facing issues, especially in advanced economies that you raised. So now there's much more talk very, very recently that they should coordinate. But coming back to the story, unless there's a miracle, so essentially that if you think about it, demand equals supply is equilibrium. So supposing your planned expenditure demand is less than supply, then it's very easy. You cut interest rates and it will boost up both output, but also because demand is less than supply, inflation is probably too low and you can meet both objectives. Similarly, if the economy is overheating, that means inflation is very high. So if you raise interest rates, you're probably going to stabilize both. So in that sense, in many cases, there need not be a conflict between instruments and objectives. You can meet them, even without, you choose your favorite god, even without your favorite god, you can by and large, meet these multiple objectives. Yeah?
So when you're going for inflation targeting and trying to stabilize economic growth, are we leaving the objective of employment to the fiscal policy and not monetary policies?
Okay, so the question is, when we target, in inflation targeting, we worry about output, do we neglect employment, right? That's going to fiscal. So I think the answer is that generally the thinking, for example, in the United States, certainly when they have these dual mandates, I think they think that if you boost the economy in general, employment will be highly correlated with that. So you can kind of, because if you want to specifically target employment, then you want to use other tools, not just fiscal policy. You may want to change, whatever you do in labor markets. For example, you have taxes on labor, you may want to change that. But generally, you don't want to use either fiscal or monetary policy for employment-specific things. The way it would work is that if you can manage to revive the economy, your employment objective would also get helped. But it wouldn't be there specifically for employment per se, because employment is determined by several other things. Above all, it depends upon how labor markets work, and that's not something that monetary policy and fiscal policy directly control or have direct control over those levers. Now, coming back to the question of, okay, in some cases, of course, miracles will not be guaranteed. Supposing there's a supply shock, right? Supposing oil prices go up or food prices go up. What you're going to see is that both inflation will go up and output will come down. Then what do? Then your interest rate objective cannot meet both objectives in a stagflationary situation, because prices will go up and output will come down. If you raise interest rates to bring inflation down, that will also affect output, and you could aggravate, you may achieve one, but you can't achieve the other. So this is a case of how, if you have one instrument, it will not be enough to meet both objectives. And in India, for example, or in many countries around the world, this happens all the time. So, that's why when we have this, there's a monsoon shock, one way or the other, we always have a struggle about how monetary policy should respond to that. So, here's how one way of thinking about how actually monetary policy actually does deal with supply shocks, or is supposed to deal with supply shocks. So supposing, and I'll give you another example. Supposing, food prices go up one shot. It only goes up once. i.e., it's not that, So if think of a case where the monsoon is bad one year, food prices will go up. Now, we have to be careful here to distinguish what affects inflation and what affects the price level. So if you have, one bad monsoon, yes, prices will go up. It doesn't necessarily mean that prices will keep rising year after year. So essentially what you do in that situation is that you have to allow prices to go up. There will be an increase in the price level, but you want to make sure that going forward, it doesn't transmit. And one way of doing that is you want to make sure that, and this is where the inflation expectations part come in, that prices going up, as long as everyone sees it as temporary, then it doesn't have to feed into expectations and change behavior going forward. So just to give you one example, if, for example, you have wage contracts that are being negotiated every year, if prices go up one year, and wages also respond to those prices, then you're in trouble, because wages will keep rising and inflation will keep rising. But if you can somehow make sure that this is a one-off level effect, that actually going forward inflation will not be affected, then wage behavior need not change going forward, and therefore this one-off shock does not necessarily have to become a permanent inflation shock. It's a price level shock, but doesn't have to become a permanent inflation shock. So that's how you try and make sure that the first round increase doesn't trigger subsequent rounds via this inflation mechanism, via people thinking, oh, it's happened once, it will keep happening. Because remember, if that expectation builds in, it can affect wage behavior. It can also affect the other savings channel. If you think, for example, inflation will keep happening, then I would like to take money out of my financial savings and start investing it elsewhere, and that will aggravate inflation. So this is the key point to remember in controlling inflation. How do you deal with supply shocks? Okay, now we come to the most, I think, interesting and complicated aspect of the inflation targeting, which is what we call, what if countries have an exchange rate target as well? So there is a famous thing which goes back to Robert Mundell. I think he was the man who explored these situations. And he said, Robert Mundell said, that a country cannot have it can only have two out of the following three. It can have independent monetary policy, which is your inflation target, exchange rate target, free flow of capital. You cannot have all three. You can only have two out of these three. It's called the trilemma. Trilemma. That is, dilemma is A or B. Trilemma is A, B or C, A, C or B, or C, B or A. That's what is called the trilemma. And that trilemma is summarized in this chart, which I'm going to explain to you after a very, very quick break. This is called the impossible trinity. You can either have independent monetary policy and a fixed exchange rate, in which case you have to forego capital mobility. You can have capital mobility and independent monetary policy, in which case you cannot have an inflation target. You can have capital mobility and a fixed exchange rate, in which case you cannot have independent monetary policy. I'm going to give you examples of each of these, including from India, to highlight what the impossible trinity is. After that, I'm going to show you a table that I think you will like, and I think that you should make it a little bit like the Bible for all students, in terms of them having to understand, how these things work, or rather, how do interest rate and exchange rates affect different actors in the economy. And I think that serves as a very useful guide for thinking about how these effects play themselves out. It's 3 o'clock. My throat needs only a very brief break, not a very long break. So this time, let's begin at 3:15 sharp, just 3:15.